This is the form that most people recognize, right? Called a London good delivery bar. I don't think is that there's a case for gold to be wiped out. Gold's going back to 2100, this kind of stuff. The central bank demand persists. The math of this terminal phase of the debt-based system persists. And so to me, the bid for physical gold, physical silver persists.
The majority of these trades are naked paper contracts, which are distorting the prices. I've been saying forever that these countries, and in particular through the sovereign wealth funds, I talked to a founding member of the CME who says you have no idea how big these sovereign wealth funds are, or like the People's Liberation Army of China, when they are importing gold or when the sovereign wealth funds are buying gold, these things aren't reported to the IMF in terms of how much gold is actually being accumulated by these countries. But what we can say is that they're bleeding down the exchanges.
I bought some gold a week or 10 days before the last move down. So I didn't really catch that correction, but now the price is higher than when I bought it. So
in today's episode, we turn to three well-known experts in the precious metals market: Andy Schectman, Craig Hemke, and Mario Innecco. Together, they analyze recent developments in gold and silver, sharing their perspectives on the sharp price movements and what's driving the market right now. We watched hours of footage to bring you the best clips so you don't have to. Beyond their analysis of current trends, they also provide their price predictions and highlight the key catalysts investors need to watch in the coming months. Whether it's geopolitical tensions, central bank policies, or supply and demand dynamics, these experts break down the factors shaping the market and what it means for those looking to stay ahead. Now we'll show you more clips, but first check the pinned comment, especially if you're a stacker, as we have a massive Black Friday deal that every stacker should take advantage of, and hit the like and subscribe button so you do not miss out our recaps. Enjoy the episode.
The majority of these trades are naked paper contracts, which are distorting the prices. I've been saying forever that these countries, and in particular through the sovereign wealth funds, I talked to a founding member of the CME who says you have no idea how big these sovereign wealth funds are, or like the People's Liberation Army of China, when they are importing gold or when the sovereign wealth funds are buying gold, these things aren't reported to the IMF in terms of how much gold is actually being accumulated by these countries. But what we can say is that they're bleeding down the exchanges. In my opinion, they know exactly what they're doing. They're coordinated, they're motivated, they're sophisticated, they're wealthy, and for the first time ever, they understand this is how you win the game. You stand for delivery. No one ever did that before. Now they are standing for delivery and doing so in a manner that is beating us at our own stupidity. It's jiu-jitsu, using your opponent's leverage against you. And then at some point, to Rob's point, we will see an establishment, I believe, of an exchange, whether it be, the Shanghai exchange, which takes center stage, or the exchange in Dubai, or the BRICS exchange, one that will install legitimacy. Just one last point. When you look at the Shanghai Metals Exchange, in order to trade a bar on the Shanghai Metals Exchange, you first have to buy that bar from one of the 6 or 7 pre-approved refineries. They are then laser etch a number on that bar attributed directly to one certificate. When you look at the West, which has rehypothecated many, 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 many times over the gold and silver contracts, similar to what the Hunt brothers realized in 1980, there is no legitimacy. And at some point, I could see the continued draining of the exchanges to the point where you have a force majeure or a closing of the ability to stand for delivery on COMEX, or something much worse on the LBMA, and how leveraged things are. So yeah, I do believe that will happen as well, Rob. And I think that they're biding their time using the Western price mechanism. They're not bitching about it. They're the ones accumulating it at this point. But at some point, when no one is foolish enough to sell at those prices, that's when I think you begin to see a transition to the BRICS exchange, to the Shanghai exchange, to the Moscow exchange, to the Dubai exchange, in a search for legitimacy. Have been looking for a opportunity to square their books, and I've been wondering how the hell they were going to do that in a market that just continued to march higher, and every time they would waste ammunition by hitting it, it would go higher very quickly. And the down days have been very mitigated, very shallow. And so I think this was an opportunity. Look, I mean, part of the exuberance, and I like the irrational exuberance statement, because it is in the respect, but it's justified on one hand in that we've all lived through bizarro world for the last 4 years on many levels. And I think people are tired of bizarro world, and they're tired of a country that favors lifestyle over merit and hard work, that favors equality over equal opportunity. And I think we're sick and tired of watching our country and the things that made this country enviable to most of the world, our culture, be whitewashed right out from underneath us. The judicial system, the electoral system, the immigration system, the lawlessness, the wokeness, and it's a breath of fresh air. And I think that has also translated into the risk on trade, where there's no reason to be defensive anymore. It's hope springs eternal, but that's misguided. And I think that's exactly what the bullion banks were counting on and hoping for, and use that opportunity to indeed flush out, the weak-handed money managers that drop the price down below the levels that trigger selling and selling and selling and selling, and they're covering. But to Craig's point, the debt, that's not going anywhere. In fact, it's obviously will probably get worse in a weaker dollar environment with low rates and a weak dollar. That's hugely inflationary. Inflation is coming. The loss of purchasing power is coming, and really what this translates into, which is somewhat concerning for a lot of the country, is again like the Cantillon effect. The wealthy will get wealthier as their assets go higher in price, which ultimately will translate into price inflation as that trickles down into the economy. We've seen this playbook over and over and over again, and pivoting away from inflation or fighting inflation when they're 65% away from their target, when Trump is inheriting an economy where the numbers that he supposedly, or the book, the economics that he is inheriting, are far from what we're being told. I mean, inflation is much higher than the 3.5% and that we're being told. Unemployment is much higher than the numbers that we're being told. The economy is in much worse shape. And so, yeah, I think that especially with what happened, I guess, to me, the big thing that I'm most concerned about is, we've seen the rates on the 10-year go higher as they've lowered the front end of the market. And again, the banks are loaded on 10-year treasuries. What we saw happen in Lindsay, Oklahoma a few weeks ago, I find to be a kind of a red flag. And the fact that it's gotten virtually no attention whatsoever by the mainstream is absolutely crazy to me. And Powell's talked about bank consolidations. I think the banks are massively over leveraged and undercapitalized, and watching rates on the back end go higher only hurts them more. But when the bank in Lindsay, Oklahoma failed, 50% of the uninsured deposits, they're gone. Boom, vanished. When Silicon Valley Bank failed and Signature Bank, they were all bailed out. Hundreds and hundreds and hundreds of millions of dollars. Oprah's money, Oprah Winfrey's money, the tech startup money, bailed out. This little podunk bank in Lindsay, Oklahoma fails, and only 7 million in uninsured deposits, only 50% are returned. The other 50%, I would argue, is the first bail-in this country's ever experienced since the legislation was written, and there's not a word of it on the mainstream. And I guess if I were going to play devil's advocate in all of this irrational exuberance, and I think some of it's justified, I do. I think it's time to be optimistic for getting our culture back, getting our country back. That's a good place to start. The financial side of things, there's a long way. We're a long way from fixing that. But if I were to throw out one concern, it's that if there really is a deep state, if things really are planned, my biggest concern is they're setting up for a fall. That you look at the BTFP, the Bank Term Funding Program, it's over. You look at the reverse repo market, it's almost down to zero. The liquidity is being yanked from the system right at a time when the banks are massively over leveraged and undercapitalized, and we should expect to see long-term rates continue to move higher. That's an unresolved problem. And so while I am very optimistic, and I think it is very optimistic ultimately in an inflationary world to expect metals to do well at some point after this sell-off commences and or finishes, I just think that it's also justifiable to be cautiously optimistic as to how this all plays out before it's all said and done. Not to be the buzzkill. I'm sick and tired of being the buzzkill. I'd rather be optimistic, and on many levels I am, but I don't think we're out of the weeds yet, not even by a long shot. And I think that people should not lose grip on their precious metals. This is what the commercial banks are counting on, for people to shed their positions in metals and make it easier for them to cover their shorts. But this is the time, I think, to really hang tight on your grip and hold.
In today's news recap, is now a good time to invest in silver? Investing in silver is a riskier play compared to gold, but there are reasons to believe that it could be a good time to buy the devil's metal. Alongside bonds, one way of diversifying a portfolio away from equities is through commodities. Gold has enjoyed a strong year, but there are reasons why now could be a good time to invest in silver. Silver prices have increased slightly over 19.9% in dollar terms over the past 12 months and 20.3% in sterling terms. Silver lags gold during this period, but given that gold and silver prices have historically been compared in order to assess the investment appeal of either, this arguably strengthens the case for investing in silver. Since hitting a peak in late October, silver prices have fallen approximately 10.4% in dollar terms and 8.2% in sterling over the past month. This could present a buying opportunity, but there are several factors to consider when deciding whether or not to invest in silver. The investment case for silver is distinct from gold. While it is similarly a precious metal with a rich history of usage in coinage, in the modern era, it is silver's industrial qualities that have the greatest bearing on its price. 55% of annual demand for silver comes from industry or tech, compared to less than 10% for gold. Adrian Ash, director of research at Bullion Vault, tells MoneyWeek, "Look around you. If something's got an on-off switch, it most likely contains silver." Other industrial use cases include brazing and alloys, the chemicals industry, and medical equipment. The latter benefiting from the fact that bacteria cannot grow on silver, an inert noble metal. For these reasons, silver sometimes tracks action in copper prices more than the safe haven precious metal. All of that said, many of the same drivers that impact the gold price, financial stress, interest rates, inflation expectations, and policy decisions, also apply to silver. Indeed, you can think of silver as gold on crack, says Ash. More irrational, more volatile, more dangerous, but also more fun if you're looking for risk. Now we'll show you more clips, but first, check our Black Friday deal in the pinned comment. If you're a stacker, make sure you're keeping all your data private and that you're browsing investing-related stuff in a safe manner. With NordVPN, you'll be sure that your privacy is never exposed. Take advantage of the limited time offer now, and let's get back into the episode.
The algorithmically programmed trading machines that make up the majority of the volume this time of day usually prompts them to buy gold futures and not sell. And then, of course, the dollar index sees that, or traders or machines or whatever that see those lower interest rates, they sell the dollar. And so the dollar index at one point today was down almost a full point. You put that together, you might expect gold to be up $30 or $40. But it's the other way around. Now, yeah, okay, is there a safe haven bid that's coming out? I mean, how much of gold's rally, even just last week, was due to Hezbollah and Iran? Not buying that one. And I sure don't think the situation in Ukraine has gotten any less scary. And so, I don't know, by deduction, I settle upon just the old bugaboo, which is COMEX option expiration day. This one in November for the December contracts is the one time all year that the front month is both gold and silver, December gold, December silver, and options on those contracts expired at the Monday COMEX close here on the 25th. Those contracts then go off the board and into delivery on Friday, which means you get these massive rolls of positions and spreads that are legged out and taken off and moved from December into February or December into March, as it is for silver. And it just makes it very easy to see price move in ways that are unexpected. It is what it is. I've been covering this stuff for 14 years. And I think even on my site today, people are like, I don't understand. Why do we put up with this stuff? Put up with this stuff because, again, this stuff is an inefficiency. It's illogical. Over time, however, gold has done a fantastic job of protecting you against the onslaught of currency devaluation. And it will continue to do just that. This other stuff, while maddening and frustrating, a lot of time is just noise. The U.S. ran a surplus. Okay, nothing but deficit spending since. That 2002 fiscal year began on October 1 of 2001. The gold price, $290. Gold price today, $2,700. That's a 9x increase. You can also look at it and say your purchasing power, as measured by gold, has fallen by 9x. So, unless you think all of a sudden this is going to change, and it can't, the government cannot, they would absolutely destroy liquidity if they tried to run a surplus again. It would be it's not going to happen. 100% promise everyone listening. Any politician says, yes, we need to balance the budget. They're either don't know how it works or they're just full of crap trying to buy votes. This will continue. Okay? I don't know if we'll go 9x again for another 23 years, but, do the math. Even in this environment where the banks manage the price and their risk and hedging this and options that and gamma this, and delta hedge that, whatever. Even in this environment, gold price up 9 times over the last 23 years while this has gotten out of control. So what is it? Another 9 times in the next 23 years. Elijah, what's that? 27,000? That protects you. That's your hedge. That's why, again, if your advisor hasn't suggested you get some, I think you should find a new advisor. Just take it upon yourself and get some.
There's a war or something, they shut the markets. We wouldn't know the price of gold, but I think when the markets reopen, people would realize how important it is to have something physical. As for the price, I'm kind of surprised how quickly gold, silver not so much, but how gold has rebounded. And it's even made a new high today in British pound terms and in euro terms. Yeah, the dollar is strong against the fiat currencies, but I think ultimately you need to measure the dollar versus gold. So the dollar is weakening again. Some people think there might be another wave down for the gold price. That's possible. But what it shows is that the higher we go, or in the gold price, the more, exciting it's going to get. And that's why you shouldn't get excited and you shouldn't get despondent when you get ups and downs. Maybe try to buy a bit when you get these big move down, if you have some spare fiat currency. I mean, I bought some gold a week or 10 days before the last move down. So I didn't really catch that correction, but now the price is higher than when I bought it. So you just have to do your best because it's more about protecting your the long-term viability of your savings. And unless you're trading, of course, and that's a different game. You should just try to keep dollar cost averaging. Silver, that's rebounded today as well, but it's still way undervalued. I still like silver. It's frustrating though, but one day, hopefully it will unshackle itself from the supply of paper out there. It's much easier to sell an ETF than And when you actually buy gold and you hold a coin or silver, you realize how precious it is that you want to hold it. But when it's just an entry on the computer, you can just like click the sell button and get out. So that's another reason to hold physical. Financial markets, and by that I mean you have to trade through brokers and stock exchanges, futures exchanges, or ETFs. They would be affected, yes, if they had to, if they said the undersea cables connecting Europe and New York they've been hit. Yeah, the markets would cease to trade. People wouldn't know, they wouldn't know where prices were. So yeah, physical gold though wouldn't be affected, even though you might not have a price set by COMEX or the LBMA in London. But the ETFs or anything that's has a counterparty attached to it, a fund, a fund manager, a bank, that will be halted for however long they think is necessary. And that happened during World War One. When World War One broke out in 1914, even the New York Stock Exchange, even though the U.S. wasn't in that war, that closed for a few months. It's very much possible. In terms of price, we don't know. We would have to wait until they reopen the markets, and it happened recently, Elijah, back 23 years ago after 9/11. They closed the markets. I don't know if you remember that, for a week or so, for some days, and then it started trading.
Do you agree with Andy Schectman, Craig Hemke, and Mario Innecco? Is Mario Innecco buying the top? They have shared valuable insights, price predictions, and the critical factors to monitor as we move into the next month. What do you think? Are you bullish on precious metals like our experts, or do you see different forces at play? Share your thoughts in the comments below. We'd love to hear your perspective. Don't forget to like, subscribe, and hit the notification bell to stay updated on all things gold and silver. Now, watch this video right here because it's a perfect fit for you. I'll see you on the other side.